Saving money and getting ready for your retirement is something that most people are taught from a young age. The majority of Kiwis contribute to a KiwiSaver scheme in order to help them get ready for their retirement and help secure them their first home. But there's a lot of risks that come with this scheme that most people aren't aware of and often don't even get spoken about, like how minimal the returns can be from a KiwiSaver fund and how it can be near impossible to actually get a first home grant. I'll be walking you through why KiwiSaver might not be as effective as you think it is and show you a potentially far more effective strategy for getting your first home and having a comfortable retirement. After watching this video, you might consider reducing your contributions or completely dropping them altogether. Remember, this is all my personal opinion and shouldn't be taken as financial advice. Always make sure to do your own research and make your own conclusions on what you think is the right thing to do, and take everything I say in this video with a very large bucket of salt. Firstly, we'll see how effective KiwiSaver is, and one of the biggest promises that the scheme makes is it will help you get into your first home. And the way it does this is by giving you a grant varying from $5,000 for an existing home or $10,000 if you're building a new property. So the biggest problem with this is that there's a massive discrepancy between the average house price in the area and what the maximum threshold is to actually qualify for one of these grants. So as you can see in the far north, to qualify for one of these grants, an existing property can't be valued more than $400,000 and a new build can't exceed $675,000. However, the average house price is $760,000, which is much higher than the threshold for both a new build and an existing home. And this trend continues for different parts of the country, even in Auckland and Christchurch as well. Really, the only way that you'll qualify for a first home grant is if you're living in a very rural part of the country. Taking a look at Kaikoui, which has an average house price of $360,000, which puts it far below the minimum requirement for the far north of $400,000, and you'll also very easily be able to get the grant for a new build as well. However, in the 2018 census, the population of Kaikoui is just over 4,400, so that means a very minimal percentage of New Zealand's population actually lives here. So the only way you'll really get one of these grants is if you live in a very rural part of the country. I personally found out these requirements through first-hand experience when I was going to purchase my first home, and I realized how low the thresholds actually were to receive a grant. I think the majority of people won't be aware of this without really finding out about these limitations until it's too late, and you might have been contributing for decades at a time thinking you're automatically going to get a grant just because you put your money into the scheme. KiwiSaver also promises to help you have a comfortable retirement. So I'll show you the average returns for the highest yielding KiwiSaver fund, which is a growth fund for both ASB and ANZ, looking at the return over a 10-year period and since inception when the fund was first made. So you can see for ASB, the 10-year average for a growth fund is just over 9%, and then when the fund was first started is 5.68%. For ANZ, the 10-year return is 8.53%, and then since the fund was made, it's 6.2%. So growth funds give you the best return because they have the highest risk investments in them, which are shares of individual companies. These types of investments make up 80% of the growth fund, and then 20% is in cash-based assets like bonds. So if you look at what the national average is for a return from people's KiwiSaver schemes, it's just 3.2%. And this is because most people don't know which fund is going to actually make them the most money. If you're investing in a cash fund, then your average return can only be just over 2% if you're looking at ASB and ANZ, which are New Zealand's two most popular banks. So those average returns will more likely than not apply to you. So if most people are only making an average of about 3%, then you'll most likely be losing money due to inflation, which historically has been 2 to 4%. And inflation is when the buying power of your money goes down as the price of goods and services goes up. Over time, things like petrol, food, rent, all increases in value. However, people's incomes and salaries and the value of their money doesn't follow suit, so slowly they can buy less and less things with the money that they currently have, meaning that if you had, say, $10,000 sitting in a savings account in a bank, then every year you'd be losing 2 to 4%, and more likely than not, the interest on your savings account is normally under 1%, so no matter how you cut it, you're going to be losing money if you're just saving it. The amount of people with a KiwiSaver account is 2.8 million, but of this, only 1.75 million are actually putting money into it, and the average balance for someone using KiwiSaver is only $29,000, so that really isn't going to be enough for retirement. So there's definitely some limitations in terms of the amount of people contributing contributing, which funds they're picking, and how much money they actually have in the scheme. There potentially isn't too much education or information provided to people on how to effectively use a KiwiSaver scheme, so you really have to ask yourself, how effective is it at getting you that first home and helping you get ready for your retirement? If KiwiSaver is fairly limited in how effective it actually is in helping you achieve your financial goals, why do people contribute to it, and what's going to be a more effective strategy? The majority of people will contribute towards a KiwiSaver scheme because they don't know an effective alternative, and it's all they really know in terms of getting ready for their retirement. It's also very easy just to set up your contributions and just forget about it and leave your money in there. It doesn't take a lot of thought or initiative or time on your part to actually look into investing and seeing how easy it could be for you, because most people don't really break past that barrier of taking the first step and seeing how easy investing can actually be. They just have these misconceptions thinking that it's really complicated, it takes lots of time, it's only for people with a background in finance, while all of these things couldn't be further from the truth. In their eyes, putting your money into KiwiSaver and leaving it up to a licensed professional is going to be the safest and most effective option, because in theory, if this person is a fund manager or a banker, they have more experience than me, they'll pick the right investments and they are going to make me the most money. However, there's always inherent risk when it comes to investing your money, and overall, no matter how good of a fund manager you are, you can't change what the market is doing. There's always periods in time where the stock market is going up, down, or moving sideways, and really regardless of what the market is doing, they're not always going to be able to make you money. The most clear example of this is when people's KiwiSaver funds were dropping considerably during the coronavirus pandemic. People were flustered trying to take out their funds, getting scared and anxious about these price movements because they didn't really understand how KiwiSaver worked, that it was a investment scheme as opposed to a savings plan, and because the money is invested in the stock market and the stock market can be volatile, the value of the KiwiSaver schemes can fluctuate quite rapidly and at an alarming rate. And if you look at the average returns for the KiwiSaver schemes in comparison to the average return of something like a broad stock market index like the S&P 500, you can see that they don't really beat out this index, and the majority of fund managers also can't beat the stock market, especially when you factor in the management fees for a KiwiSaver scheme, which for say an ASB growth fund is up to 0.64%, and that's a fair amount of money if you're thinking that you're going to be contributing tens of thousands of dollars to a KiwiSaver plan over the course of your lifetime. So the most effective way to get ready for your retirement without a KiwiSaver plan is by investing in a broad stock market index like the S&P 500 that I mentioned earlier. Essentially, this is just a collection of the top 500 biggest publicly traded companies in America. If you look at some of the top companies in the S&P 500, the vast majority of them are very recognizable, big branded companies that everyone is familiar with. So number one is Apple, and that makes up just over 7% of this index, and then you can see Microsoft sitting at 6%, and then Amazon just over 3%, and then other companies like Johnson & Johnson and Visa, JP Morgan are all included in this index. So all these companies are very strong and have valuations in the hundreds of billions or trillions of dollars, meaning it's going to take a substantial amount of money to actually bring the price of these down and make you lose any money as well. So historically, this index has given people an average return of 10% per year, and this is across several decades at a time. Some years it can go up 20%, other years it might just go down 2%, or it might move sideways for several years at a time. If you take a look at this chart here, you can see that there's periods of time where the S&P 500 will virtually do nothing and have very minimal price movements, and then it can also have fairly decent drops at just over 30%. You can see here when we had the coronavirus pandemic, but in the long run you're always going to be making money over time because you're not trying to make money in the short term. Saving for your retirement is a long-term process, and because your money is diversified across multiple businesses, that means you're not at the mercy of one sector or one company. So this always means over time you're going to have a nice consistent return. Instead, you're relying on 500 of the biggest companies in the world to make you a profit, which is very much a winning strategy. There's also no management fees for this ETF because no one is picking and choosing which companies are put into it. They're all just ranked on the size of the company. So as a whole, investing your own money will make you much better with the money that you have. You'll actually start researching investing, thinking about how to manage your income. You're not just leaving it up to someone else and shutting your brain brain off to thinking about finances and doing a bit of general learning about the stock market. While that might not be everyone's cup of tea, investing your own money into a broad diversified index is something anyone can do, and it takes no prior knowledge or previous investing history to get started with. If you take a look at the average return of investing your money in a KiwiSaver scheme versus in the S&P 500, there's a massive difference between the two. So if we take a look at how much money you actually make from KiwiSaver in comparison to investing in the S&P 500, we'll take a look at the average return of contributing to a growth fund for ASB and ANZ. So with this comparison, we'll be making a few assumptions with the KiwiSaver fund. First of all, that someone will start contributing at the age of 20 and retire at the age of 65. So that's 45 years where they'll be putting their money into the KiwiSaver scheme. And I know that $52,000 might be a lot of money for someone that's in their 20s, but this assumption is that you stay on a salary of $52,000 for your whole life. You get absolutely no increase in pay, which most likely would never happen if you're working for 45 years. And the other assumption is that you'll be putting in 3% of your income, and that 3% will of course be matched by your employer. And on top of that, you'll be putting an additional $1,000 a month into your KiwiSaver scheme. So that means the grand total for ASB will be 1.38 million, and for ANZ 1.59 million. Now this sounds quite good, but how does it compare to the S&P 500? So with the S&P 500, our assumptions will be that you're putting in again $1,000 a month. Just like the KiwiSaver scheme, you'll get an average return of 10%, which is the historical return that the fund has provided for decades, and that you'll be again doing this for 45 years. So the grand total for the S&P 500 will be $8.6 million across the same amount of time, and actually having put in less money as well, because you're not topping it up with 3% of your weekly income, and there's no employer contributions as well. So you can see that the S&P 500 will far outperform any KiwiSaver provider at over $7 million as well over these 45 years. And this is comparing it to the most profitable KiwiSaver scheme. If you were looking at, say, a balanced or even a cash fund, these returns would be far lower and the difference would be even bigger. Of course, investing is not going to be everyone's cup of tea, but it really is much easier than people think. It's not about timing the market, spending hours researching companies, always on your phone or computer, looking at your screen. It can be a very set and forget strategy. All you have to do is set up an automatic payment from your bank account into a brokerage platform, and then from the broker into the S&P 500. Now, while KiwiSaver might sound like a really good plan on paper when you look at it, in the long run, when you actually compare it to other investment options and look at some of the limitations, it really isn't everything it's cracked up to be. I think some general financial education would go a long way in comparison to just making everyone pick a KiwiSaver scheme, teaching people about taxes, inflation, what the process is to get a business loan or getting a approval from the bank for a mortgage, telling people about the risks of taking out credit card loans and the high interest that banks charge on these would all go a very long way to help people become more efficient with their money. And if you're interested in learning how to use a New Zealand brokerage platform to help you get started on your investing journey so you can replicate some of the gains I showed you from the S&P 500, I'll be comparing New Zealand's 3 most popular brokers, which are Hatch, Sharesies and Stake. I'll be looking at their fees, what companies they let you invest in, and giving you a complete guide on all 3 of them, all the way from setting up an account to making your first investment. So make sure to check out this video on screen so that you can make an informed decision on which broker is the best for you and help you get started on your investing journey and prepare for your retirement.